What if I told you that a stock index created back in 1896 still moves markets today? That despite being just 30 companies, it's mentioned on the news more than any other index in the world? Welcome to the Dow Jones Industrial Average, or just the Dow. Do you know that from 1985 to 2025, the Dow 30 weekly price increased around 32 times, and the annualized return over this 40-year period is approximately 9.1%? In this video, we'll unpack what the Dow really is, how it's calculated, why it still matters in 2025, and how you can invest in it wisely. Let's dive in. The Dow Jones Industrial Average, or DJIA, is one of the oldest and most iconic stock market indexes on Earth. It was created in 1896 by Charles Dow and Edward Jones, originally to track the performance of just 12 industrial companies, think railroads, steel, and oil. Today, it includes 30 of the largest, most influential U.S. companies, from tech giants like Apple and Microsoft to household names like Coca-Cola and McDonald's. So, why does the Dow matter? Because it's still seen as a symbol of American economic strength. A quick pulse check on Wall Street. The Dow Jones Industrial Average, DJIA, is calculated using a price-weighted formula. It adds up the stock prices of its 30 component companies and then divides that total by a special number called the Dow Divisor. This divisor adjusts for stock splits, dividends, and other changes to keep the index consistent over time. Unlike market cap-weighted indexes, the DJIA gives more influence to higher-priced stocks, regardless of company size. Let's talk about why the Dow's price-weighted method is often considered unfair. First, it ignores company size. A company like Goldman Sachs with a high stock price but smaller market cap has more influence on the Dow than a giant like Apple, especially after stock split. Even if Apple is worth trillions, its lower share price gives it less sway. Second, stock splits distort weight. If a company does a 2-for-1 split, its weight in the Dow is literally cut in half, even though the business hasn't changed at all. Third, arbitrary impact. A $10 move in a $400 stock is just a 2.5% change, but it moves the Dow more than a $10 move in a $100 stock, which is a 10% jump. That doesn't feel right, does it? Fourth, it doesn't reflect how most people invest. Most investors own shares based on market cap, not stock price. So the Dow isn't really representative of real-world portfolios. Now, compare that to market cap weighted indexes like the S&P 500 or Nasdaq 100. They weight companies by size, not price, so the biggest companies have the biggest influence. This method is widely considered more modern and accurate because it better reflects the economy and actual investor holdings. So why is the Dow still around? Simple. It's historic, created back in 1896. It tracks 30 blue-chip giants across all industries. And it's still quoted in headlines and media as a symbol of economic health. Is it perfect? No. But is it iconic? Absolutely. So, who makes up the Dow today? Here are just a few of the 30 blue-chip companies in the index. Apple, Microsoft, Boeing, McDonald's, Johnson & Johnson, JP Morgan Chase, Home Depot, Coca-Cola. These companies span industrials, technology, healthcare, finance, and consumer goods. And while 30 might sound small, these firms represent the heart of corporate America. The Dow Jones Industrial Average, or Dow 30, doesn't follow a rigid, rules-based formula like the S&P 500. Instead, it's curated by a committee at S&P Dow Jones Indices, who carefully choose companies based on long-term significance, not just numbers. Still, there are some clear inclusion guidelines that shape how companies make it in. Let's break them down. First, U.S.-based companies. All Dow components must be headquartered in the United States and listed on a major U.S. exchange like the NYSE or Nasdaq. Second, blue-chip status. These companies are household names, financially sound, well-known, and industry leaders. We're talking about firms with strong brand recognition, proven track records, and real staying power. Third, large market cap. While there's no official minimum, most Dow companies are mega-cap, typically worth $100 billion or more. Their size needs to match the scale of the other 29 giants already in the index. Fourth, High trading volume and liquidity. To ensure smooth performance, companies must have strong liquidity, meaning their shares are actively traded and easy to buy or sell. Fifth, industry balance. The Dow isn't just about size, it's about representation. The committee aims for a balanced mix across sectors like tech, healthcare, consumer goods, finance, and industrials. That's why companies like Salesforce and Amgen were added in recent years to reflect modern shifts in the economy. Sixth, stock price matters. Here's the twist: because the Dow is price-weighted, a company's share price affects its influence on the index. So, extremely high-priced stocks, like pre-split Amazon or Berkshire Hathaway, are usually excluded unless they split their shares first. And finally, board discretion. The index committee has the final say. They may remove companies for reasons like declining relevance, mergers and acquisitions, or overrepresentation in a sector. In short, getting into the Dow 30 is about more than just numbers. It's about stability, legacy, and leadership, representing the backbone of the American economy. The Dow 30 is the oldest and most iconic U.S. index, tracking just 30 blue-chip companies using a price-weighted method. It tends to favor industrials and financials and is often cited in media headlines, but it excludes many tech leaders due to its outdated methodology. The Nasdaq 100 focuses on the top 100 non-financial companies listed on the Nasdaq exchange, with a tech-heavy and growth-oriented profile. It uses market cap weighting and includes innovation leaders like NVIDIA, Apple, and Amazon, making it popular among aggressive, tech-focused investors. The S&P 500 is the broadest and most widely used benchmark of U.S. economic performance. It tracks 500 large-cap companies across all sectors using market cap weighting, providing the best overall picture of the market, and is the go-to index for long-term investors and professionals alike. Over the long term, the Nasdaq 100 has delivered the highest growth, with an average annual return of 12 to 14%, thanks to its concentration in tech and innovation-driven companies. The S&P 500 follows with a solid 10% average return, offering balanced exposure across all sectors. The Dow 30, while more stable, has historically lagged slightly behind, averaging 7 to 8% annually, reflecting its conservative, blue-chip focus. In terms of volatility, the Nasdaq 100 is the most volatile. Its tech-heavy makeup causes sharper ups and downs. The S&P 500 is moderately volatile, while the Dow 30 is the least volatile, offering steadier performance during market stress. Despite their differences, all three indexes are highly correlated, especially during major bull or bear markets, meaning when one rises or falls, the others often move in the same direction. However, their sector weightings and risk profiles make a big difference in how they perform over time. Let's break down the strengths and weaknesses of the Dow Jones Industrial Average, also known as the Dow 30. First, the strengths. The Dow is time-tested and globally recognized. It's been tracking the U.S. market for over 125 years. It focuses on financially stable, dividend-paying companies, which makes it attractive to income-focused investors. And for beginners? It's simple. With just 30 companies to follow, it's much easier to understand than broader indexes. Now, the weaknesses. It includes only 30 companies, so you get limited diversification. It's also price-weighted, an outdated method where higher-priced stocks carry more weight, regardless of company size. And it has less exposure to high-growth sectors like emerging tech, biotech, or AI-driven startups, compared to indexes like the Nasdaq 100. Final take. So while the Dow isn't perfect, it still serves a valuable purpose, especially for conservative or income-focused investors who want blue-chip stability over flashy growth. So, how do you invest in the Dow 30? Let's break it down step by step. Step 1. Understand what you're investing in. The Dow Jones Industrial Average tracks 30 blue-chip U.S. companies, the most stable, well-known names in the market. It's not as high growth as the Nasdaq, but it's known for dividends, resilience, and long-term strength. Step 2. Use ETFs. You can't buy the Dow directly, but you can buy ETFs that track it. The two most popular are DJIA, the SPDR Dow Jones Industrial Average ETF, DJD, the Invesco Dow Jones Industrial Dividend ETF. These funds hold all 30 Dow stocks, mirroring the index. Step 3. Open a brokerage account. Use a platform like Fidelity, Vanguard, or Schwab. Or try Robinhood, Webull, or a robo-advisor like Betterment or Wealthfront, which often include the Dow in their portfolios. Step 4. Decide how much to invest. You can start with as little as the price of one ETF share, around $300 to $400 for DJIA, or set up automatic investing with fractional shares over time. Step 5. Reinvest dividends. Most Dow companies pay strong, consistent dividends. Reinvesting those dividends boosts your compounding power over the long run. Step 6. Think long-term. The Dow isn't about fast gains. It's built for slow, steady, conservative growth. So hold through market cycles, stay the course, and let those blue-chip giants work for you. Here are the final takeaways of this video. The Dow Jones Industrial Average is over 125 years old, but still relevant in 2025. It's not the most modern index. It's not the most diversified. And it's not the fastest growing. But it represents legacy, resilience, and financial strength. If you're building a portfolio that values stability, the Dow may still deserve a spot. Just pair it with broader or tech-focused indexes to balance things out. Thanks for watching. If you found this video helpful, don't forget to like and drop a comment below. We'd love to hear from you. Subscribe for more insights on investing smart, growing wealth, living wisely, and walking with purpose. See you in the next video.